And in our advanced investment appraisal, first we are looking at how do we evaluate, most especially these are organic growth or internal growth of the business, different projects of the business. So when it comes to investment appraisal, it's about evaluating projects, evaluating different investments, using different techniques that we need to look at. Now, what we are going to discuss in this chapter, number one, we are going to look at maybe relevant cash flows a bit. Relevant cash flows. Number two, we shall look at appraisal techniques. Number three, we are going to look at inflation and tax. Inflation and tax in investment appraisal. Investment appraisal. Then number four, this one is a bit big. We shall look at risk and uncertainties. In investment appraisal. Number five, we shall look at capital rationing. In investment appraisal. Number six, we are going to look at replacement decisions. Replacement decision. Number seven, we are going to look at adjusted present value. Our APV. And number eight, we are going to look at international investments. So you see that it is a very big part, and I think we can cover it today and tomorrow. That's my target. That today and tomorrow we cover this investment. When we meet again, we cover something else. So these are the areas. Anything I've left out?
You have talked about the inflation tax.
Yes.
How about the effect of exchange rate?
That is international investments.
Yes.
Yeah, we shall discuss them in international investments.
It is another chapter.
No, it is under here, part 8.
Oh, okay.
International investments. Now, if we look at our part, the first part we are going to talk about is the relevant cash flows. Now, in our investments, when it comes to investments, most especially in these questions, what is important for you is to identify the relevant cash flows on the project. You either pass a question or fail a question from this part, identifying the cash flows that are relevant and the cash flows that are not relevant. Once you identify the cash flows, it becomes easy for you to apply a technique. But if you fail to identify cash flows, then it will be hard to identify it, to apply it. Even if you apply a technique, the answer is already wrong once you have failed to identify the relevant cash flows. Now, what are relevant cash flows? When we are defining relevant cash flows, these are cash flows which influence our decision making. If a cash flow is going to influence your decision to invest or not to invest, that cash flow is relevant to your decision, and therefore you should consider that cash flows in your decision. So these are cash flows which influences the decision to invest. As long as the cash flow is going to influence your decision to invest, then that cash flow is relevant to your decision, and therefore you should recognize it in your decision making. So they change with the change in the decisions. When they are going to affect your decision. So what are the characteristics? Characteristics of relevant cash flows. Number one, they are future cash flows. Relevant cash flows are future cash flows, meaning you are going to incur them as a result of your future decisions to invest. So in that case, you are going to recognize them. Number two,
Your future decision to invest, or you take a decision today to invest.
if you take a decision, you will incur you are going to either get the money or incur the cost due to your future decisions.
Sorry?
The decision you are going to incur in the future, as long as the cash flow are going to affect your future cash flows, then those ones, they are, maybe I can give an example. I can give an example.
Yes.
If I'm to accept to teach this course online, am I going to consider the cost the cost I purchased this computer?
I think so.
Will I include the cost of purchase? No. If I have already a computer, I have a computer already. Now
Yes.
I'm making a decision whether I should accept this offer to teach the online class or not. Am I going to consider the cost of the computer I purchased? Which I already
No,
have?
because you already have.
I already have this. What I need to look at is the data I need to conduct this class.
Okay.
And maybe other relevant issues. So we are looking at what are the costs to be incurred because of the decision that we are going to make.
Okay.
That's what I said, your future cash flows. There are incremental cash flows. What do we mean here? What we mean here is that you expect an increase or a decrease in your cash flows because of the decision. your cash flows will increase or decrease because of the decision that you are making. So we look at what are the cash flows with a decision and what are the cash flows without a decision. Then we recognize the increase or the decrease in your cash flows. Number C, there are cash flows. What do we mean here? You are expecting either a cash in or you are expecting a cash out because of the decision. It is either cash in or a cash out because of the decision that you are taking. That's why I say there are cash flows. Then if you look at other aspects of relevant cash flows, we have a working capital. And when it comes to working capital,
excuse me, on number C, you said there are a cash flow.
You are expecting either cash in. Here, we expect either a cash in or a cash out to the decisions. So we are ignoring, for example, depreciation, which is not a cash in, a cash out. Sorry.
Or maybe they are not there are.
They are.
Even number B, I think it is they are.
They are incremental, yes. So we are looking at working capital as another aspect. Yes.
I didn't get where on B. They are incremental cash flow.
So what we look at in incremental cash flow, what we look at, what are the cash flows without a decision? What are the cash flows after your decision? For example, if my revenue, let's say my revenue is 1 million, by implementing a decision, my revenue is going to be 1.5 if I implement the decision. So it means in this case, my incremental cash flow that I'm going to go as relevant will be the 0.5.
Excuse sir.
Yes.
Just making a decision can cause a revenue to increase.
That's why I said it is either an increase or a decrease in the cash flows. Because increment, for example, if I'm evaluating, for example, a machine, let's say I'm evaluating installing a machine. The operating cost of the machine, currently the operating cost is 10 million. And by installing a new machine, my operating cost is going to be 5 million. So it means my relevant cash flow will be the difference, which is a decrease in the cost. Tumvikanye?
Yes.
So incremental, it can be an increase or a decrease. Don't look at it in the way it is written, but it can be an increase or what we are looking at the changes in the cash flows because of the decision you have made. What are the changes in your cash flows because of the decision? So another aspect that we are looking at is the working capital. Working capital many investment projects, they require investment in working capital, or many projects, they require investment in working capital. So when we are recognizing working capital, we are looking at when are we investing in working capital. So when the period you are investing in working capital, you are going to recognize a cash outflow. But we expect that at the end of the project, the money you invested in working capital is going to be recovered. So at the end, we expect that you are going to recoup the money invested in the working capital. So, and then recognize a cash inflow. So at the period of investment, recognize a cash outflow. And at the end, of the project, the money invested That's what we are saying. If I have a project and I'm going to invest in year 1, year 2, year 3, that's the project is 3 years. And maybe in year 1, my working capital, I'll invest maybe 100 million here, 100 M in working capital. Here, maybe I'll need 120 M in working capital. So we expect that at the end of the project, so how are you going to you are going to recover the money that you have already invested? It means here in year 1, how comes? So if I'm looking at the investment in working capital here, my investment in working capital, it means here I recognize 100 million investment in year 1. So, but in year 2, I recognize the incremental, which is going to be 20 M investment in working capital. Then at the end of my project, huh? Recognize here. At the end of the project is ending, I recover 20 plus 100, which is 120 million investment in working capital.
Dr. Nuvuga ngo hariya mwanditse working nayo yari asanzwemo, nayo yari asanzwe muri working capital, noneho tukaba tugiye kongeramo investment.
Watangiye muri mwaka wa mbere?
Yego, n'uwa kabiri hariya mwanditse working capital.
Working capital.
Nuvuga ngo ayo ngo nayo twari dusanzwe dufitemo.
Oya? Cyo turi kuvuga hano. Uri ku evaluating a project ekeneye miliyoni 100 za working capital mu mwaka wa mbere. Ariko mu mwaka wa kabiri aya mafaranga aziyongera agere kuri miliyoni 120.
Ubwo ni increment, okay.
Ni increment.
Noneho hariya handitse investment sasa turashaka kuvuga.
Novuga novuga mu mwaka wa mbere invest uzashiramo amafaranga angahe? Or your incremental. Maybe I should use incremental. what will be the incremental cash flows? Mu mwaka wa mbere yaba miliyoni ijana yari wa investinzemo, ariko mu mwaka wa kabiri zaba miliyoni 20.
Okay.
Then at the end you recover
Okay.
the 120 million, the total amount you recovered.
Yes. Thank you.
Welcome. So that is working capital investment. Then another thing that we need to talk about here is opportunity cost. So if we forego an income, or the alternative foregone should be recognized as a cost to the new project that you are establishing. So the revenues or income foregone in order to implement a new project or should be recognized as a cost to the new project. Being evaluated. So if you are foregoing, let's say, if I can give an example, if I have a building, and I'm receiving a rental income from that building, maybe of a rental income of 2 million. Let's assume that. Now I'm starting a new project, and this new project is going to be implemented in the building, which means by implementing that project in the building, you are going to forego this 2 million that you are receiving from rent. So when I'm evaluating the new project, I should recognize this 2 million as a cost to the new project.
May you come back a bit on that example?
I'm saying of the building which you are renting at 2 million every month, every year. None your building ugiye kuyishiramo new project. So ushizemo new project, aya mafaranga wabonaga nago ugiye kuyahomba cyangwa bavuga gute? You're not going to get the money anymore. Nago urongera kubona aya mafaranga. So when I'm evaluating the new project I'm putting in the building, those 2 million should be recognized as a cost, as an opportunity cost to the new project that you're evaluating.
Okay.
Yes. So that is the opportunity cost. So look at where there is an opportunity cost and recognize it in your analysis. Number 3 is the finance costs. The interest you are paying on the loan should not be, if for example, you are financing a project using a loan, automatically you will be paying a loan on that, you will be paying certain interest. So, but the interest we are paying on the loan, we don't consider it in our analysis. It's going to be irrelevant because the cost of debt incorporates the interest. So interests are not considered in your investment analysis. So interest paid on loan is not considered in the investment analysis because it is included in the cost of capital. So please, when you are having an interest expense and you're evaluating a project, those interest expenses are not going to be considered. So that's why you take the profit before interest and tax, because the discounting factor that you use to discount your cash flows, it includes already this cost of capital. I mean this interest. So don't include the interest. Number 4, we have the residual.
So you say it's because we use the interest before what?
Yeah.
You say
The interest is included in the cost of capital. So when we evaluating,
the interest of debt that is going to be used as the discount factor.
Yes.
It already incorporate the finance cost.
Yes. So the residual value of asset should be recognized So if you have an asset and the asset has got a residual value at the end, that residual value of that asset, you should recognize it at the end of your project. So then, as we summarize this one, so what are the irrelevant cash flows? Which cash flows are we not going to consider in our decision? Number 1, we have the depreciation. Depreciation is irrelevant cash flow, but we shall recognize it probably in tax. But when we are looking at the expense of depreciation, is irrelevant to our investment decision. But it has got some effect on tax. That's why we shall look at it in the details. Number 2, we have also the sunk cost. There's a cost incurred in the past. The cost incurred in the past. That's what I was saying in the first part, because we said we are looking at future costs. So any cost incurred in the past is irrelevant to your decision. You are not going to take it. That's what the question, the example I gave. If I have already purchased a computer and I'm evaluating whether to accept the offer to teach online, I'm not going to consider the cost I purchased the computer because it's there. Even if I accept the decision or not, I still incurred this cost. Allocation of an existing fixed cost. Allocation of an existing fixed cost. So if you already have a fixed cost, that one is going to be relevant. You cannot distribute a fixed cost because of the decision you are making. Because even if you don't, you still have the same fixed cost. So allocation of an existing fixed cost is irrelevant. Number 4, we have the committed costs, which are the same as fixed costs. Committed costs, costs that you are supposed to incur or you are going to incur irrespective of the decision. That's what we call the committed costs. Costs incurred irrespective of the decision made. The cost that you are going to incur irrespective of the decision you are making, which are the same as fixed costs, they are also irrelevant to our decision. So when you are looking at your cash flows, please, you need to look at this aspect, which is very important to identify which cash flows are relevant, which cash flows are not relevant to your decision. So that is number 1 in our discussion.
So,
Yes.
again, now, talking of irrelevant cash flow, why not the finance cost is not under irrelevant cash flow?
But you can, as long as we are saying it is irrelevant, but you can put it anywhere. But I think it has no issue. You can put it anywhere.
Okay.
But still here it shows that it is irrelevant. So another part, which is number 2 now, is investment appraisal techniques. Investment appraisal technique.
Excuse me.
Yes.
On committed costs, you mean the cost incurred irrespective of the decision made or irrespective of the investment decision?
Investment decision. Whether you undertake an investment decision or not, you are going to incur that cost.
Okay.
So we are looking at number 2, which is investment appraisal technique. Now, when we talk about investment appraisal technique, of course, these are techniques that we use to evaluate our investment appraisal. Once you have our cash flows, what comes next is to evaluate our investment. Now, these techniques, we classify them into 2. Number 1, we have the non-discounted techniques. Where we have the payback period, and we have accounting rate of return. Return, sometimes we call it return on capital employed. In some books, you may find it is return on capital employed. Others, they call it accounting rate of return. So if we start with the first one, payback period. Payback period. I think these are it is the period it takes for the project to cover the initial investment. How long will it take for the project to cover your initial investment? That is the payback period. Now, if the cash flows are constant, or when the cash flows are constant, you have the same cash flows every year, the payback period will be equal to the annual cash flows, initial investment divided by the annual cash flows. If you have cash flows which are constant, you just get your annual cash flows divided by the initial investment. Then you can get a payback period. If the cash flows are not constant, or when the cash flows are not constant,
Excuse me, sir.
Yes.
What you are saying is not what you are writing. Like the formula for finding the payback period. You've said it is annual cash flows divided by initial investment.
Initial investment divided by annual cash flows.
Okay.
Yes.
So
when the cash flows are not constant, the payback is determined by accumulating the cash flows until the initial investment is covered or is recovered. When you are dealing where cash flows are not constant, what you are going to do is to accumulate your cash flows until you cover your initial investment. So what is the decision rule? Accept an investment where the target payback is below the calculated So when you are making a decision, you are going to compare the target. The target is what is established by the management, that we want the project to cover in 2 years. That's going to be the target period. Then compare the target with what you have calculated. If the target is below, not the calculated is below the target, not the target below, above, sorry. I think it's the calculated is below the target. So what are we saying here? You have a target payback of 3 years. That is your target. Now you have calculated your payback is 2 years. In that case, you are going to accept. But if your payback is 4 years and you want a project to pay in 3 years, in this case, you are going to reject. That is what we are saying in that sentence. So we can look at a simple example. Let's look at this. Company X is evaluating a project that requires 100 million. The project will generate this amount of cash flows in different years, 30, 45, 20, 40, and 50. The management only accepts investment that do not exceed 4 years. It means our target payback is 4 years. That's what it means. So how do we evaluate? So this is our period. These are cash flows. These are accumulated cash flows. So I have period 0, that's the period of investment. 1, 2, 3, 4, and period 5. So period 0, I need to invest 100 million. That's what I'm going to invest in period 0. Period 1, I will get cash flows of 30. I will get 20 in year 2. I will get 40. I will get 40. 45 here. 20. I will have 40 here. And I have 50. Now, what will be my payback? I'm going to accumulate. I start with the period 0 here. That's the money. Then period 2, I get this because I'm accumulating plus this. Then here, I will get this plus this. Then here, I will have this plus this. Then here, I have that plus this. The moment my cash flows become positive, it means I'm covering the money. But I'm covering between year 3 and year 4. Year 3 and year 4. So how do I compute your payback? If I can, maybe I can write it. If I can calculate my payback period, my payback period will be, because I'm covering here, so it's going to be 3 years plus the balance to cover. The balance to cover is 5 million divided by the cash flows in which the balance was covered, which is 40, then times 12 to put into month. So I will get 3 years and how many months? 3 years and yes, 3 years and how many months?
1.5.
Like a 2 months.
Yes.
So the project is going to be covered in 3 years. In 3 years and 2 months. And our target is 4 years. So what does it mean? Accept.
You will accept.
Accept the project. Maybe you can give me 2 advantages and 2 disadvantages.
Excuse me, sir.
Yes, please.
Suppose in year 2 we made a loss.
Here.
Yes.
Of course, the money you need will go up.
Then the accumulated
will go up
and influence the payback
yes
period. Okay.
Yes.
Excuse sir.
Yes, please.
On the first example where you have said that on annual cash flow, they say the constant annual cash flows. You get the investment divided by annual cash flows. Does that challenge give you the return period where you can compare with the answer?
Yeah, because what you have, for example, if I have a project that is going to be giving me that require 100 million,
Yes.
that's the project. And my annual cash flows, I think my annual cash flows that I will be getting maybe 40 million every year. That's the money I will be getting every year. So how long will I take to cover this money?
2.5.
So
2
in
years and a half.
2 years and a half, I will have covered the money.
Yes.
Yes.
In the formula of payback period, you ignore the negative sign.
Which one? No, you don't consider the negative. The negative means that's the money you still need to cover.
Okay.
So I'm not going to talk about advantage and disadvantage. These are advantages of payback. I may not talk about them.
So is it 3 years and 2 months or for 4 years? Because if you
No,
get
you are
five,
covering between year 3 and year 4. So you need 3 complete years and some month in year 4.
so 1 point, how have you converted the 1.5 in 2 months to get the 3? Because if you get,
if you multiply by 12 here, it means you are putting the answer in a month. 5 over
So
40 times 12.
you get 1.5.
That's we just rounded off.
Okay.
So I'm not going
Is
to
it
talk
even
about
impossible to put in days to be more precise?
to put in days. It's going to require another calculation, but you can put in days. You multiply it by what? The 0.5 into by what? By 30.
And 365.
Probably. So I'm not going to talk about these ones, advantage and disadvantage. I think these ones are not something that challenge. What's the advantage of using a payback period? I don't think someone can ask you that, but maybe it is easy. It is easy to use. It is used in screening. In screening of investments. Mostly when you want to screen investments, this one is very much applicable to screen investments. It uses cash flows. Those are some of the advantages. Disadvantage? It ignores
Time value.
time value of money. Two, cash flows at the end of the project are ignored. Or cash flows after the payback. After the payback are ignored. And others. I'm not going to be talking about the advantage and the disadvantages of these techniques, but I think you can be able to get something from this. Then number 2, we said accounting rate of return, or sometimes it is return on capital employed. ARR so it is the return generated on every investment in it. It is the return generated on every investment made in the asset. So how much profit are you earning from the investment you make in your assets? That's the return on or accounting rate of return. So when we are computing our ARR is average profit divided by average investments or average investment or average assets. And our average investment, we shall get our initial investment plus the residual, then I divide by 2. In that case, I get the average investment. So if you look at another simple example, So let's look at this. Company X is evaluating an investment that requires 50 million in asset or investment in asset. The asset have a useful life of 5 years and a residual value of 10 million at the end. The asset will generate the following incomes. Year 1, you'll have 12 million and that one. The management require a return of 25 to accept any investment. That means our target accounting rate of return is 25%. So we are supposed to evaluate the project. Now, what do we need? First, you can compute your average investment. Average investment, which is 50 million plus 10 million. Then I divide by 2. And I think this is going to give us 30. That's the average investment. Now I can compute my average profit, or I can compute my depreciation or accumulated depreciation. What's going to be the accumulated depreciation of the asset?
Excuse me, sir.
Yes.
Come again on the average investment. Why do we calculate the average investment?
Why do we
calculate the average investment?
Because we are making investment in different years.
Oh.
That's what we are making investment in different years. So if you are investing in different years, what you need is the average.
Okay.
Yes. What's going to be the accumulated depreciation? It will be the value of the asset, which is 50, minus the 10. And we get 40. Then, what is our total profit? Total incomes. So will be, if I can put in 12 million, or you can add the total there, 12, 27, 47, 55, 65.
65.
So what will be the average profit? My average profit is going to be equal to 65 minus 40 divided by 5. You get what? 5 million, eh?
Million.
5.
Yes.
So what's going to be our ARR? Will be 5 million divided by 30. And you get
16.7.
So what decision are you making?
Reject.
We are rejecting.
But why are we removing depreciation from the average profit?
In this case, we are assuming that these profits are not, they are before depreciation, PBDT or PBD.
So how can you know that? Yet they are not mentioned in the question.
But in most cases, if such a question are like that, you assume that the profit, those are some of the assumptions that you need to make. We assume that the profit is before depreciation, unless if it is mentioned.
Okay.
So please, you can look at the advantage and the disadvantage of these techniques. So number 2, this was an undiscounted. Is discounted cash flow techniques. Discounted cash flow techniques. And under the discounted cash flow techniques, of course, you have different techniques. We have the net present value. We have net present value. We have the IRR, or the internal rate of return. We have the profitability index.
Excuse me.
Yes.
Please scroll up and I note something down.
Huh?
Thank you. Scroll up and I have to note something.
Okay.
Like average profit. I have not seen it well.
Yes, please. Yes, Yvonne. Hello, Yvonne. I'm seeing your hand up. Hello, Yvonne. Pakaniye.
ashobora kuba yibeshye kakana atabizi.
ashobora kuba yibeshye.
So, net present value. So it is the total present value of the cash inflows less the initial investment. I think that is how it is. It is the total present value of all cash inflows less the initial investment. That's the NPV. And how do we just discount the cash flows? Because we are looking at the present value of the cash inflows. That's the initial investment. It means you just discount the cash flows to cover the initial investment. I don't think these ones, I would have even have preferred to just look at an example and then we move on, because we are used to these techniques. IRR, we talked about it in the other profitability index. Can we just look at an example? Maybe we look at an example for this.
Scroll up.
Wait, I finish the question. So let's see, because this one is very common, I just wanted us to look at a simple example to go through these techniques together, how to use them together such that we don't waste a lot of time on it. So we have this company is evaluating a project that requires 100 million investment in a new asset. The company will also need to invest 20 million in working capital at the start. I didn't put that, but it should be at the start of the project. You see how to add it. Maybe I can say working capital will be invested at the start. Working capital will be invested at the start of the project. So this is what we have. These are the units we needed to. So what do we need? First, we need our revenues.
Scroll up, please. Again.
Can we move on? Because I'm going to share the Excel.
Yes.
Yes, we can move on, sir.
Move.
So our working one is going to be revenues. Working one is revenues. And I have year 1, year 2, year 3, year it's not fitting. I need another period here. Year 1, year 2, year 3, year 4, year 5. My units here, I'm going to put them in thousands. Uh-huh. 150, 100, 150. This is 100. This is 150. This is it, 90. This is what? 130. And this is 110. Then my selling price is 500. 500. You can just scroll, I think. So my revenues is this times this. So that's my revenues. Then I can go for working 2. My working 2 is the variable costs. I think I can copy this. The variable cost per unit is it? Variable cost per unit is how much? Oh, you didn't copy it. It's 200. It's 200. So my variable cost, I just get this times this. Then what else I have? I need now to get my part 1. I'm evaluating part 1. Evaluation using NPV. So I'll have my period here. I can yes, I need a period 0, which I don't have. I'm stuck. Maybe I can reduce a bit here, a bit here. I want one bit here. I can create one thing here. So it means I need period 0, period 1, period 2, period 3, period 4, period 5. My revenues, working 1, I can copy my revenues here. And if it will move away, it is going to come back. These are the revenues. Then my variable cost, I can still copy this. So I would have put a minus to show it is a minus. Then I needed the fixed cost, which is 5,000. And it is constant. So what am I getting here as my profit? This is my earnings. Then I have my machines, investing 100 in machines or assets. So we call them assets. By investing 100, since it is in year 0, it is minus. We also invest working capital. Working capital at the start. So my working capital here is 20. But we said when you make investment in working capital, you recover it here. So I recover 20 here in my last year from working capital. I have a residual value of how much? The asset has got a residual value of who? What's the residual value? You're not following, it seems. It's 20.
20 million.
The residual value is 20 here. So what will be my cash flows? We are ignoring taxes and other items. So my net cash flows will be this is my net cash flow. This is my net cash flows. Our discounting factor, because our cost of capital is 12%, that's the discounting factor at 12%. So you remember, please mute. Our discounting factor is at 12%. So it means here I will have 1 or bracket 1 plus 0.12. Remember that's what we said. The formula you still remember, we've been using it. Power, or you can read your table. Power minus n. So I can scroll here and I can divide like that. So what is my present value?
Question, sir.
Yes, please.
In year 5, I see twice. I see 20 twice. One, I can see that it is.
Maybe I would have made a separate column here. We can make a separate column if we want. Maybe here.
Yeah, because
make a separate
one.
I can
me
make
also
a column.
I was going to ask you the same question.
You're going to ask the
same capital in the
maybe I can say put here residual value. Isn't it? If I put residual value and I remove it there, 20. Does it make sense now?
Yeah, yes.
Is it okay now?
And the
residual value. The residual value of the asset at the end.
Okay.
None siriya working capital yo ni yiki?
That's what it travels.
Mwaka wa nyuma nyene barayikupinga.
Nibo investinze muri working capital mwaka wa nyuma amafaranga urayagaruza. So recognize it as a cash in.
Okay. Kandi none se nitwari twinvestinze 100?
Oh yeah, working capital. Oh yeah, 100 ni muri asset.
Okay. Nabyumvise. Uvuga ngo both residual and working capital tuzaziri copying.
Yeah, kwa asset ugiye kuyigurisha at the end kuri $20,000.
Okay, yego nibyo.
So, is it okay now?
Yes.
So what is our NPV? We just make this summation and we erase this. So our NPV will be equal to so in this case we are going to reject. It is positive, eh?
Yes, it is positive.
So we accept. since NPV is positive, we accept. Accept the project. Is it okay, friends?
It's okay.
It is good.
So that is it. That is how we use the NPV rule. I have not gone through the what and what. Our part 2, they want us to get the IRR, the internal rate of return of the project. And you remember what we were discussing in the cost of capital? We said IRR is equal to A plus NPV at A, B minus A, this is a NPV at A minus NPV at B. I think that's what we said last time when we were discussing the cost of capital, most especially when we are discussing the redeemable and the convertible debts. So so I've already got a positive. I need a negative. And being the fact that my NPV is positive at 12%, I need to increase the rate. So I'm going to copy only these ones. Is it okay? I want only to copy the last part here, the cash flows, not the entire part. Because this is the way we summarized all the cash flows. Is what I want to copy here. I need to copy special. It's also not correct. Okay. So, but what I wanted is the cash flows. So, can we say NPV at 25% to see if we can get a negative NPV at 25%? Because at 12% we have this 10. So I'm increasing my discounting factor here. What are they thinking? Discounting factor at 25%. And what are we going to have here? I didn't put the period. This is year 0, year 1, year 2, year 3, year 4, year 5. Okay. So it is the same, 1 plus 0.25 power
0,
but minus okay. So what do we get here? This times this. So what's going to be the NPV here?
the total.
NPV is equal to, I'm going to get the total. From here up to here. So I have a negative. So it means I have a positive at 10. I have this, and a negative at 25. I have that. So I can interpolate. So my IRR is equal to 0.12 plus 10, 0.26, 0.61, sorry, into 0.25 minus 0.12 over 10, 0.61.
Yes.
Minus become plus, eh?
Minus the plus, yes.
It is a plus. Plus 26.
26.
927. So what is the calculator say now? The calculator is saying what is the IRR, friends? What is wrong?
Maybe is 15.54%.
Okay. 15.54%. So how do we make a decision? Remember the cost is our cost is 12%. So since the IRR is above the cost of capital, the project is accepted. Then, number 3, we are talking about profitability index. Or what called the PI. So it is the ratio of the present value of the present value of the cash flows to the initial investment. So you are measuring how profitable the project is based on the initial investment. Then in that case, you calculate the PI. And how do you get the PI is equal to the present value of cash flows, then divided by initial investment. Then you get your PI. Or if you don't use this, the PI or the PI will be equal to NPV over initial investment then what you get plus 1. You can still get the NPV divided by the initial investment, then plus 1. Or you can get the present value of the cash flows divided by the initial investments. Then you can still get your profitability index. You want to look at how profitable the project is basing on your initial investment. So NPV and the ARR almost measure the same thing. Only that PI and the ARR, they are measuring the return you are getting on your investment. But PI is on discounted cash flows. The other one is on undiscounted cash flows, but they almost measure the same thing. So if you look at our question, our total present value, if you look at the question, we are answering, our initial investment is initial investment. If you look at the question we are trying to answer, the initial investment is this. This one, the same. That's the initial investment. Then our PV of cash flows.
Do you include the investment in working capital?
Yes.
Do you include the investment
initial investment? It includes the investment in working capital and the investment in asset. So I'm going to add the summation of all my present value of the cash flows, which is here. I can also copy my NPV to show what we are talking about. My NPV is this. So if we look at this, our PI will be equal to 130 130, 0.61 divided by 120. And so we are getting this divided by this. That's the PI. Hey, what am I doing? So if I use the other one, still I'm going to have the PI equal to 10, 0.61 divided by 10 plus 1. So it's the same as having this. I think I need a bracket. Divided by this.
Then
what I get, I add 1. So which gives me the same answer.
Merci du fond. Je vous remercie du fond.
So that is how you can compute your PI. Decision. Our decision. Accept if PI is above 1. Otherwise, reject. If your PI is above 1, accept. If it is below 1, reject. Then number 4, if you don't have a question, is the modified payback period. Modified payback period. Now this modified payback period, we just accumulate the same way. Only that here. Yes, please.
The reason why you are saying that if the PI is above 1, we should accept. That means the 1 indicates the amount of investment.
Yes.
Okay.
So n excess above is a profit. It means here you are getting a profit of 8%.
Okay.
Yes. So this involves discounting the cash flows and then accumulate to determine the payback period. So it is just to solve the other problem within payback period of ignoring the time value of money. So here you consider the effect of time value of money. Please, Mr. Urafunga nyuma. So you are going to discount the cash flows first, and then you determine the payback period. So if we look at our period, we have 0, 1, 2. If I can maybe make we show it clearly. 3, 4, 5. So if you look at our cash flows, if I first consider undiscounted, if I consider the undiscounted cash flows, what will be the payback period? I don't know if I can copy them and they accept. Will they accept? These are the net cash flows for undiscounted. Can I copy special? When I copy them, they will move away. They will not accept. This is a 120. This is 25. Yeah, this is positive. This is 40. This is 22. This is 34. And 68. So if we look at this first, I want us to first look at this first, such that we can understand how the impact. So this is the accumulated cash flow. So if you remember what we did in the last part, so I get this plus this. I have this plus this. I have this plus this. And I have this plus this. So it means the project is covering between year 3 and year 4. If we don't use, we use the normal payback period. So I will say for normal payback period, it will be 3 years plus 33 divided by 34, then times 12. You get what? 3 years and how many months?
Hello?
Yes, please.
At 3 years period, we still have a negative.
But it is covering between 3 years and 4 years. That's why we are saying 3 years and some months in year 4.
Okay.
Does not yes. So 3 years and
11 months.
And 11 months. If we don't discount, that will be the payback, 3 years and 11 months. Now, suppose we look at the discounted, the one we are looking at now. What will be the effect now? This one is still the same, I think. This one is going to be year 1. I can copy. Year 1, discounted is 20. Year 2, discounted is Have I copied the right figure? I think I've not copied the right figure. I copied in the different one. Year 1, this I'm copying in this. It will be this. Year 2, it will be this. Year 3, it will be this. Year 4, it is this. And year 5, it is this. So can we accumulate? Accumulated. So I'm going to have this as usual. So this plus this, this plus this plus this plus this, and this plus this. So if we use the discounted cash flow, the project will pay back our payback period for modified payback, or our modified payback. I don't know if you'll be able to separate these two. This is the modified. I think I should use a different color. Our modified payback will be, we are covering between year 4 and year 5. So it will be 4 years plus 28, 524 divided by 38 585. So it will be 4 years and